Welcome to the December Centre of FinTech podcast series. And today we have Ina Alogwu with us, and we're very grateful for Ina's presence here today. Ina is going to be talking about a holistic approach to running a FinTech business in an emerging market. So we're going to be asking Ina, his ideas. Obviously, Ina has a wealth of experience, and I'm going to be talking about Ina's really amazing profile in a minute. But just before I do that, just a little on what the Centre of FinTech is about and who we are and what we do. So the Centre of FinTech is a research and practice-based centre based at the University of East London, and it is actually focused, or if you like, located at the Royal Dutch School of Business and Law. It's also a center that was established in collaboration with the School of Architecture, Computing and Engineering. And the idea around the Centre of FinTech was to basically leverage the expertise in the very multidisciplinary area of FinTech across the universities, basically catering for the finance, the technology, and the legal and regulatory dimensions of FinTech. And as part of our remit, or part of the work that the center focuses on, public engagement is a quite key dimension. And through this method or mechanism, we engage with industry partners, we engage with organizations that are in the FinTech space, some of them startups, and some of them already existing financial institutions. And so as part of that remit, or as part of the work that we do, we have, from time to time, industry players come to speak to us about the work that they're doing in the space, come to speak to us about sometimes the work that they do within the Centre of FinTech, and the opportunities, for example, that exists in FinTech and the future of FinTech. And so today we're very delighted to have, as I said earlier, Mr. Ina Alogwu. And Ina, if I may, is a distinguished professional with over 19 years experience in the digital commerce and mobile payment space, providing thought leadership in identifying key innovation and technology trends, initiating and driving the execution of new digital product initiatives. He is contributing to the next wave of growth in digital commerce, mobile payments, wealth tech, championing cross-border strategic growth initiatives for the Pan-African FinTech ecosystem. And over the course of his career, he was responsible for driving various digital strategic initiatives that have been launched in various markets across Africa. Ina has led the development of innovative platforms that facilitate fraud management, e-commerce, agency banking, mobile financial services, and alternative payment methods. He has developed and executed a digital business strategy for the largest card scheme in Nigeria to launch the next generation Pan-African digital payment infrastructure. He's currently the Group Director of Digital Transformation at ARM Group, where he is overseeing the execution of the group's digital transformation strategy, helping the 7 subsidiary companies in the group's drive through digital initiatives. He also oversees the operation of 3 venture building programs for the ARM Group. The venture building programs that are run under ARM Labs brands includes an incubator, an accelerator program focused on African FinTech and property tech startups, and an SDG impact-focused program. He holds a postgraduate diploma in digital business and an executive master's in digital transformation and innovation leadership from the IE Business School. So we're very delighted to have Ina here today joining us. And we have just a few questions actually for Ina, and we're hoping that this will be a very engaging that's a few minutes of Ina's time, and we hope that you enjoy just listening to Ina answer these questions. And Ina, we hope that you enjoy also sort of taking these questions. So without further ado, can I just politely ask you if I'm just hoping that I haven't left out anything in your amazing profile. And if I have, if you want to, take a couple of minutes to sort of, maybe tell us additional things that you do, or if you're, quite happy with the way that you've been introduced. Over to you, Ina.
Thank you, Dr. Iwa. It's an absolute pleasure to be here. It's a privilege and an honor to be given this opportunity by the University of East London. You've done a very good summary. The only thing I left out was personal things about myself. One personal thing is I love to cook. If I wasn't doing this, I probably would have been a professional chef. I guess that was the only thing I'd like to add. But it's an absolute pleasure to be here, and I'm really looking forward to having the conversation.
Okay, well, thank you so much for that. I heard that you were also a brilliant cook. That's amazing, and that's also very useful. Brilliant. Thank you so much for that. Without further ado, so I'll dive right into the first question, which is really around what are the skills, really, beyond technical acumen that startup founders must have that are often overlooked, but are critical to the growth and performance of a tech startup. But before maybe you answer that question, just to provide a bit of context for our listeners as to really how, I know I've spoken a bit about your profile and things and read from your biography, but if you tell us maybe in 2 minutes, really how you get to what your typical day of work is like with startup founders and these types of particularly tech startups, and then we'd go into the first question. Thank you.
Absolutely. So I spent a significant time of my career working with one of the foremost unicorns out of Africa, and that company happened to be one of the first generation FinTechs that emerged and that provided financial services that served both players within the financial services industry, directly to consumers, and some corporate institutions that include both public and private institutions as well. And during my time there, I spent a couple of years decoupling most of the payment products that we have to ensure that we're able to provide the rails for startups to be able to connect to the APIs that I worked on, working with the technology team to build, to enable them to build very innovative solutions. And that being said, I had the privilege of working with several tech startup companies who were able to build lots of innovative products and services leveraging. As I mentioned, I'd worked with one of the first generation FinTech companies to, create platforms and APIs that supported tech startups who built very innovative use cases to address either B2B, B2B2C, or direct consumer solutions, specifically in the financial services industry. And because I've had the privilege of working with those startups to connect to our APIs to activate whatever use cases they decide on, I've been able to see from a technical perspective and a business model perspective what works and what doesn't work. And then when I joined my current employers, ARM, I then had the privilege of running the operations of venture building programs at various levels. Some of the venture building programs focus specifically on very early stage companies. And then we recently launched an accelerator that has a scope beyond just very early stage companies, but also pre-seed and seed stage companies. And that helped me to see things from a very different perspective. And because I run the operations of those venture building programs, we've gone through the selection process to determine what startups have the right qualities to succeed and eventually become unicorns. And I've worked with global accelerators like Techstars, leveraging their playbook that essentially has gone through years of refining, that defines what kind of qualities startups typically have beyond technical acumen and even beyond business acumen. And this is moving to the culture and the people side of things. And that really has helped me to see a lot more beyond the skills that you typically find with very young founders. And I've seen founders who are very good technically, very good on the business side, but they lack some soft skills that has really almost cost them years of work that they've spent building the company to a particular level. And I'm really looking forward to talking you through some of those examples without having to mention specific names. But I think you'd find it very insightful regarding what we other skills that we think tech startups need to have in order to go through the different phases of growth that we typically find going through.
Brilliant, thank you. And so let's just dive into those skills now. So what are the skills really that startup founders must have that often are overlooked but are critical to the growth and performance of tech startups, obviously beyond, like you say, technical acumen?
Absolutely. So what you find is you do have founders who have worked in a corporate environment before and perhaps are used to certain processes beyond what you have as the core competence of the organization, and they're able to apply those experiences when they do, set up their own companies. But a lot of tech founders have probably never worked in a formal institution before, and sometimes they encounter challenges that would require a different set of skills beyond what you've learned from a technical perspective. And one of the ones that come up very often is people management skills. And I think it has to do with the fact that successful founders are often people who are very passionate about the problems that they're trying to solve. Their goal is usually not really financial gain, but really they are motivated by something beyond that. And while that tends to be a very critical ingredient that founders need to have in order for them to succeed, sometimes that passion tends to get in the way of situations that they need to manage from an emotional perspective. And what you find is when you need to understand what is important at what stage you are as a startup. So you typically start as an early stage company. You go through a phase where you then cross what we call the valley of death, and then you get through a growth phase. And that's where you hear people say things like pre-seed stage companies. When you get to seed stage and you get to Series A and Series B, you are now becoming a more mature company. But when you are a very early stage company, what really is important that you need to succeed is not the product that you built, because typically the product is still in the prototype phase or it's just in the launch phase. So it hasn't yet, gotten traction to start bringing enough revenue to get the company to grow. What is really important are the people behind the company at that point. Not all of the people who are important to get you through the pre-seed stage would be founders that have equity within the company. So you need to do a lot more to be able to attract and retain the right type of talent that you need to take your product to the stage where it is now in the growth phase and is now generating a lot more revenue. And what you find is that founders typically don't understand the importance of keeping the right team together. And keeping the right team together requires that you apply the right level of emotional intelligence and be careful not to allow your passion for getting your business to grow at the expense of how the people within your team feel, because they will find other jobs and they will leave you. And what you might think replacing them is easy, but what you might not realize is that the time you would lose getting the new people who are replacing them to get used to the business is valuable time that would allow your competition to get ahead of you. So it is extremely critical for you to identify, and I know it is not practical for you to be able to make everybody within the company happy, but the truth is you would have some key people that you need to convince to stay with you throughout that journey, because remember that they're making a sacrifice to help you build your dream. And so you have to try and understand what's in it for them, because what drives you may be very different from what drives them. So what motivates them to stay, knowing that as a startup, you will never be able to compete from a compensation perspective. They'll always find better paying jobs, but there will be a reason why they need to stay with you. And you need to be in a position where you understand what motivates them, You ensure you define precisely what's in it for them. So you solve the what's in it for me problem. And you just simply make yourself a pleasant person to work with and try and empathize with them when, for example, sometimes they may need to address some personal problems that will prevent them from coming to work. Don't take it too personal. You need to understand that, like I said, you need to be able to apply the right type of emotional intelligence when it comes to those sort of situations. And I've seen examples of startups who almost lost their business because they were putting their own dreams ahead of the needs of their key staff. And they came across as being a bully. And it turned out that this specific startup I was mentioned, and I can't mention their names, is they had a very high staff turnover, and that greatly impacted their ability to get to market very quickly with some of the critical products that they needed to get them through the growth phase. So people management is extremely critical, and I've seen so many times, and in this example I've just given, that actually became a complaint that was made official and was made known to a new investor that was about to put in money in that company. And that really, eventually they did get to raise money, but not before some major changes were made in the company that required some of the founders to actually step down. And so,
if I just come in here, because there's so much that you've mentioned, and I kind of think maybe I've got some questions that may clarify some of the, basically some of the comments and explanation that you've actually given. So I just wondered, for our listeners that are very new to, how startups, begin and what they need, and basically the people that they need to work with them. I just wonder, just to sort of rewind a bit, to find out, on average, from your experience, right, what on average would you say is the amount, of staff that a typical startup would have, just on average? Because I'm thinking, I mean, some of, when you talk in terms of sort of people management and things, these are typical things that an HR department would try as much as possible to be on top of. So I just wondered, on average, what's the size, if you like, of a typical startup that you engage with?
Sure. Now, it depends on what stage the startup is in its growth cycle. If the startup is in the early stage, or what we call pre-seed stage, you would typically find the staff strength between 1 and 10, in some cases 1 and 20. And as you would imagine, in such a startup, you would not have well-defined roles that you have in more mature companies. So at such a stage, sometimes the CEO plays as the head of HR. So he's managing both the strategic direction of the company, and he's also managing the people side of things. So where you find that the founder, if there's one founder or whoever it is that's the CEO, or any of the other co-founders are playing the role of HR, then they have to have the skills that a typical HR person would have, and know how to manage people. And that's really why it's important for founders within that stage of the company to have people management skills, because it's what you do that determines whether or not the people that will help your business to grow would remain with you. And if you don't have people management skills, you end up losing critical staff who may not have equity within the company, but have the right skills to have taken you through that stage that leads you to growth. And usually when you normally as a startup, you would bootstrap, you would go through the very rough days, and then you get to the stage where your business starts to achieve traction. That really is the part that we call the valley of death. And that's really where many startup companies actually go out of business. And when you hear people say things like most startups will fail, that's usually the stage where they fail.
Brilliant.
And again, one of the major reasons why they don't succeed is because they are unable to attract and retain the right type of talent that they need to get them to the growth phase.
Brilliant. Thank you so much. That just clarifies it. And I'm sure our listeners will find that's clarification very useful. But because we have quite a few other questions, I'd be quick with the questions because we want to maximize your time and what we can get from you this afternoon. So what role can startups play to facilitate the digital transformation effort of an incumbent player who is looking to transform their business models to enable them to remain competitive?
Absolutely. So when people use the term industries, I tend to see people who talk about industries are people that live in the past. And really, there was this misconception that startups operate in a different bubble, while the incumbent companies operate in a different bubble. And the truth is, both startups and incumbents are operating actually within the same market, and sometimes they may be in direct competition with each other, where the competition is symmetric, and in some cases, competition may be asymmetric as well. Because what you find is that the value proposition of the startup may be addressing the same need of the value proposition of the incumbent. I don't like to use the word conflict, but sometimes when you find that startups start to play in the same market that incumbents play, incumbents actually have two choices. The first choice that the incumbents typically have is to try and partner with the startups to create something that is of better value to their customers. And in other cases that I've seen very often is that the incumbents actually try and compete with the startups. In some cases they succeed, in some cases they don't. But I think if you look at this from the customer's perspective, the customer will get a lot more when there's collaboration between the startup and the incumbent. And what you find is most incumbents, especially those whose operations predate the digital era, are having now to adapt and evolve their business model to leverage digital technology. And then sometimes within those incumbent companies, their legacy processes, their legacy technology, and even the culture that exists there prevents them from achieving that objective quicker. And what you find is that, and this is based on the experience we've had as ARM, where we adopted the approach of partnering with startups rather than trying to compete with them, is that startups actually being digital natives that are not really bogged down by the biases of legacy culture and what formulas that we used to succeed 10, 15 years ago. You find that startups working with incumbents actually deliver more value to customers. And what I think, again, based on the experience we've had and the successes we've had working with startups, is that a startup may have innovated and built a certain technology that the incumbent does not need to build from scratch. And so in the incumbents' efforts to try and build solutions that leverage digital technology that delivers new digital experiences to their customers, working and integrating with those startups can help the incumbent achieve that objective. And conversely, what that also does for the startup is that it opens them up to new markets that would ordinarily have cost them a lot more to be able to acquire in terms of customer acquisition costs. So an incumbent, for example, may have 1 million customers who are in need of a specific service that needs to leverage the technology that the startup has built. And rather than the incumbent building that solution from scratch, they can simply identify what startup that has such a technology and have a conversation as to what commercial terms are agreeable to both parties. And a simple integration allows the incumbents to be able to activate that use case for the 1 million customers and agree perhaps on a revenue share with the startup. From the startup's perspective, they now have access to 1 million customers. From the incumbent's perspective, they're able to get to market quicker because they don't need to build that solution from scratch. And then there's a symbiotic relationship that then exists. And ARM does have examples that we've been able to launch new products without having to, go through the product development process that usually takes between 3 to 6 months. And just by integration to a startup that has the existing technology, we've launched those products. And then those startups also then have access to a retail customer base that ARM already has. So that's a very good example where startups can play a very critical role with helping incumbents to achieve the objective of digital transformation. And from startups' perspective, it helps their business grow quicker because they are, getting additional revenue from a customer segment that they would ordinarily have cost them time and resources to be able to open up. So I do think in Europe, those kind of collaborations are already being facilitated by PSD2, which is the Open Banking Initiative. But in developing markets like ours, it actually takes a deliberate and conscious effort, and a wise one, by the way, by the incumbents to take the option of collaborating rather than competing, or what people like to call co-opetition, which is deciding when to collaborate and when to be smart about when to collaborate and when to compete.
Brilliant, which actually takes me to the next point, that question that I wanted to ask. So in terms of a market like Nigeria and on other emerging markets that you engage with as ARN, because of course I'm aware that you obviously engage with other economies beyond where you're located, which is in Nigeria. I just wonder though, so what, in terms of sort of percentages, what is the success rate, would you like, of incumbents working very successfully, if you like, with new tech startups, for example? What's the success rate in terms of, if you can quantify that in percentage terms, just to give us an idea, because you did a nice comparison saying that in Europe, under, for example, PSD2, this works quite well. There's that nice collaboration happening. But in the context of an emerging market, what's it like?
The disadvantage we have in emerging markets is that we haven't had the benefit of regulations like PSD2 that enforces incumbents to open up APIs so that startups can build innovative solutions. It's hard to put a quantitative number behind it, but you would actually rarely find incumbents that are willing to collaborate with startups. And that's because, very strangely, they see them as threats. And I guess one of the things that you must do as a human being is you need to understand what your strengths are and what your weaknesses are. And I believe that that's applicable at the corporate level as well. As an incumbent that has been in the industry for a while, especially if you operate in a very heavily regulated market, you would have developed processes that perhaps would have reduced your ability to execute things quickly. And I think especially in the market that we operate in, whether it's financial services or otherwise, I guess it's the false expectation that it's a winner takes all, because it isn't. The market is always big enough. And remember, in developing markets, you still have a very large addressable market of people who are either financially excluded or don't get access to enough financial services. There is no way, and if that were possible, then we won't have that many financially excluded people in our markets today.
Yeah.
If it were possible for the incumbents to be able to address that segment, they would have addressed it long ago. And I guess you can't achieve a different result by doing things the same way. It's a new world where what used to work before doesn't work now. And so as an incumbent, you need to recognize where you have your strengths and where you have your weaknesses, and find a partner who complements your strengths. Business models are evolving. The business model where the ultimate goal was to kill your competition and take the market from your competition is past. We now live in an era where the people that thrive are people that believe in the ecosystem model, where you recognize what your role is within the ecosystem, you ensure that you're efficient enough to deliver value, and you work very well with other partners who, by the way, could be startups, and in most cases are startups. So I guess, back to the answer to your question, it's very hard to say 10% of incumbents partner with startups while the remaining 90% try and compete with them. But I guess from a qualitative perspective, I would say it's not very common to find incumbents willing to partner with startups. And that's because they're still living, in my view, in denial. that a winner takes all is possible. And again, in my view, I don't think that that's a realistic expectation anymore. And you need to start thinking about yourself as, where am I within the ecosystem that allows exchange of value between demand and supply? And so if you look at our counterparts in the banking industry, very few banks, and in fact, only the banks that came into existence very recently are very receptive to working with startups. You find that other banks have decided to float subsidiaries to try and compete. But then I guess as time goes on, many incumbents will start to see the benefits of working with startups, especially when they see how much value that fellow incumbents are getting from working with startups. And I think they might start to change their view as to what the option is between competing directly or collaborating to create an ecosystem.
Well, thank you so much for that. And it's also very interesting that you refer to the banks, because while you were talking about in Europe, that that competition doesn't particularly exist because you have regulation that's kind of facilitates that facilitates, if you like, a nice collaboration between incumbents and startups. But what came to mind really was the competition that existed, and to a certain extent still exists for us here, or I'm based in the UK, between challenger banks and our traditional banks. So I'm talking in terms of Barclays, NatWest, HSBC, in comparison to challenger banks like Monzo, Revolut, and the like. And whilst the challenger banks, what you could say, tech startups are quite nimble and quite sort of easy to work with the technology, we still find that it may not necessarily be the case with the incumbent banks, and hence that you almost feel like there's that competition still existing. But my next question, which is very linked to this point that you tried to sort of explain, or the initial question, is how can regulation, I suppose we've mentioned a bit about regulation, but how can regulation practically now facilitate the growth of FinTech? And what would be your recommendation regarding an approach that would help bridge the gap between startup ecosystems and regulating and deregulating entities?
I think the challenge that regulators are finding now is not new, and I think regulators all around the world were a bit confused as to how to regulate FinTechs, for example, and that's because they were very different from the traditional entities that they were used to regulating. And I'll give you a typical example. The typical approach for regulation was, we need to regulate from a risk reduction perspective. However, the rules that the startups live by is take risks. So how do you apply an approach that comes from the angle of risk reduction to an entity that is used to taking risks? And what you found was many regulators had to go through a learning curve trying to define a new type of regulatory regime to be able to regulate startups. And that's where you have things like RegTech coming up. It turns out that in developing countries like ours, the regulators are starting to go through that learning curve. The problem we find is, while they go through that learning curve, the damage that may happen from the unintended consequences of regulation actually leads to the death of so many promising startups. And that's what I think incumbents have a moral obligation to try and prevent. And that is by helping the regulators to navigate that learning curve quickly before it results in so many promising startups going out of business. And typically what you find is, again, one basic principle from a regulatory perspective, as one person I really respect once always said, is the regulator always takes the approach of, when in doubt, say no. Again, because they're coming from a risk management perspective. If I don't really understand this thing, I need to be sure about how it impacts the consumers before I say yes. And sometimes it takes a while for the regulators to understand a new technology that can unlock new value. And so there is not much the startups can do. Startups have their own battles to fight. They have very limited resources and very little time within which to get through that phase where they have to get into growth so that they can continue to survive. The incumbents who happen to be stable have to help the regulators to try and understand what new technologies are and how it actually helps to support the goals of the regulator, so that the regulators don't come up with regulation that has bad unintended consequences for the startups. So if you take blockchain, for example, or if you take cryptocurrencies, for example, it took a while for many regulators to really understand the benefits of cryptocurrencies and blockchain and how it actually benefits the financial services industry. And I think if the incumbents did a lot more with helping to bridge that knowledge gap, perhaps we would have had better regulation that would maybe have allowed startups who were building solutions based on blockchain and cryptocurrencies to be able to survive. And I guess what I'm saying in essence is that that bridge between the regulators and the startups has to be bridged by somebody. And I think the incumbents have a very good, they're in a very good position because they have a relationship with the regulators and they have a relationship with the startups in the startup industry. If they can bridge that gap and bring the regulators and the startups closer together, get the regulators to actually really understand that the startups aren't cowboys who are building risky solutions, but are actually just innovators who just need some guidance as to how to do things right. And helping the regulators to understand that the startups are actually an integral component of helping them achieve their financial inclusion objectives. And without startups, without tech startups, I don't think any regulator can achieve their financial inclusion goals in any market. So bringing the startups to the table when regulatory decisions are being made is actually a very critical thing that has to happen in emerging markets. And I believe that incumbents have a moral duty to achieve that objective. So two things: getting the regulators to understand startups and getting startups to understand the regulator, ensuring that the startups have a seat at the table when regulatory formulation decisions are being made, so that all of those components that result in undesirable outcomes for the startups can be identified and corrected. And regulation should actually support the growth of startups rather than the other way around. Because if regulation supports the growth of startups while protecting the consumers, what it does is that it helps the startups to flourish, collaborate more with the incumbents, deliver more to customers, existing customers and new customers, and by so doing, help the regulators achieve their financial inclusion goals.
Brilliant, thank you. I found that really very insightful, very interesting. Very interesting, particularly your take on the role that incumbents can have in bridging the gap between the startups and the regulators. And I really agree with your point. I really agree with your point that, if regulators don't get it right, a lot of these projects can be killed before they actually, get going. It makes me think of the regulatory sandbox and the idea around having regulatory sandboxes across different countries. So here in the UK, for example, the Financial Conduct Authority runs a very successful regulatory sandbox, which quite a few countries in emerging markets are kind of trying to want to adopt as well. And obviously, we know that the sandbox approach is where you have, new startups, innovative firms wanting to, giving them the opportunity to actually trial out their business, their project in a controlled environment with oversight from the regulator, but with an oversight to give them an opportunity for the regulator to actually engage with them. Talk in terms of financial inclusion, you talk in terms of sort of crypto, blockchain, when we talk in terms of sort of all these types of recent emerging technologies and their linkages with financial services, one of the things that stick out is that they're pretty much cross-border global type transactions. And so in my mind, there seems to be a need to have some sort of global framework that facilitates the creation of regulation that doesn't stifle innovation. And so when we think in terms of this sandbox for regulators, in my mind, it feels like there's a need to actually give regulators the opportunities to engage with other regulators that have been there, done it, won the t-shirts, haven't killed companies, have facilitated innovation, but in the context, that context has to be right. But I think it's something that, countries really need to begin to think about, sort of seek out regulatory or seek out sandboxes type initiatives where they can learn, so that we're not killing, like you say, companies before they actually sort of, start out, and then defeating the idea, like you rightly say, of financial inclusion and things. So thank you so much. I quite like the contribution that incumbents also can have a role in bridging the gap there. Hadn't really thought about it, but that's really useful. I'm sure our listeners would find that useful too. So to the next point, and I'm very conscious that time is going. The next question is, what key areas do you see opportunities for fintech startups in emerging markets in the next 2 to 5 years? So this is really stealing from your expertise and your experience. I'm sure startup companies that are watching this podcast would really want to hear from someone like yourself on that.
Absolutely. And incidentally, this was a point of discussion in my recent trip I made to Kigali, where we were talking about the distribution of funding that was coming through from venture capitalists and private equity firms. And you find, and if my statistics, if my memory serves me right, you find that I think it's in H1 of 2022, about 44% of funding that came through to support startups actually went to the financial services industry. And that's because banking or payments, if you like, which attracts most of the funding coming through from VCs and PEs, tends to be the most attractive value proposition to investors. And that's because the funding is coming from international sources. Typically, investors based from North America and Europe tend to be more comfortable investing in problems that they can relate with. Unfortunately, because we're in emerging markets, there are problems that are more profound that more advanced countries may, have gone past since the 1950s or 1960s. But those are problems that still exist in emerging markets. And sometimes when an investor who is not really used to emerging markets listens to a founder describing a problem that he can't really relate with, he often fails to be able to see what opportunities lies behind being able to solve that problem. And by so doing, create opportunity for scale for the startup, which again can potentially increase the return on investment on whatever equity is getting if it does decide to invest. And one of those examples has to do with an industry that incidentally in this part of the world is the last to go into recession and the first to come out of recession when a country's economy slips into recession. And that sector is the agricultural sector. Usually the agricultural sector, being one of the largest employers in emerging markets, is the last to go into recession and is actually the first that comes out of recession and actually ends up pulling all of the other sectors out of recession. Is one big area where incidentally it doesn't appear in the top 10 destinations for investments. Health, on the other hand, that is also a very critical sector where so many opportunities exist because so many Africans don't have access to health insurance and have to pay out of pockets to consume healthcare services, is actually number 5 when it comes to destinations for investments. So where you would find the largest, the biggest problems, which also presents the biggest opportunity and hence the largest addressable market, doesn't tend to get the attention it gets now. So health tech companies, agri-tech companies, in terms of the problems they're solving are so profound, and in terms of how many lives they'll be touching, are far more than consumer discretionary products and services. For example, that's actually the second largest beneficiary of investment from VCs and PEs. And really is what, if you're looking about impact-based investment or impact-based value propositions, would be agriculture and health. Payments is important, but payments is not the biggest problems we have. I mean, people are able to pay in some way, but there's no alternative for consuming healthcare services. If somebody doesn't have access to healthcare services, the person doesn't have access to healthcare services. So I would like to think that the financial services is now being seen as a crowded space because you have so many neobanks trying to, struggle for the same set of customers that the traditional banks and the other digital banks are trying to address, and are unable to build products and services that appeal to the unbanked sector or the informal sector, as we call them, because the way they consume financial services is very different from the way upwardly mobile people like you and I consume financial services. But I guess the opportunities for growth that I see is entities or startups that decide to build solutions for the informal sector to solve their financial services needs, health tech companies that increase access to health insurance for especially the bottom of the pyramid, and agri-tech companies that solve huge problems along the value chain for agriculture from the point of production to the point of consumption. I think are very, very good opportunities for startups to engage in. Thankfully, we're seeing an increase in the number of Africa-based VCs that are led by African investors. So they'll be able to relate more with this problem and would, have more positive decisions with regards to whether or not to invest in these companies that I've just mentioned. I guess, and again, if you look at the statistics from funding coming from Silicon Valley and from Europe, you find that it's been declining since Q4 of 2021, although the H1 performance of 2022 for Africa has been astonishing and has defied what you've seen globally. I think if you look at the analysis from investors, the amount of funding coming through to Africa would actually start declining, because between Q3 and Q4 of this year, there was a drop in the growth of funding coming through. So from next year, we'll start to see less funds coming through from international sources, but we hope that will be complemented by the growth of African-based venture capitalists and private equity firms, and hopefully we'll start to see startups who are building solutions to address these issues that are spoken about, financial inclusion for the informal sector, improving access to healthcare services, and solving supply chain problems in agriculture, which in my view is what would really impact the GDPs of countries in the developing world. Hopefully we'll start to see that happening.
Brilliant. Thank you so much. Yeah. Thank you so much. It's very insightful. Thank you for that. So agri-tech and health tech, predominantly firms. Wow, amazing. Well, thank you so much. Very informative. Thank you. I mean, the next question I think you've covered, which is around sort of the regulatory climate in an emerging market like Nigeria, where ARM is based. But because we've covered that, a bit of that, I wanted to sort of extend that now to sort of a regional framework. So financial inclusion has come up a few times in this conversation. And obviously we know financial inclusion is a big problem on the African continent. And, part of the conversations we've had already sort of is looking at opportunities to facilitate financial inclusion, foster financial inclusion, but much more sort of from a perspective of supporting, startups, fintech startups, some of the examples you've already given. So I just wondered though, from, we usually hear that regulation to be effective in facilitating, fintech, in facilitating financial inclusion, it should be, given the opportunity to, it shouldn't stifle innovation. Yes, or should facilitate innovation. And I just wondered, though, I mean, you've spoken a bit about the context in certain emerging markets, about how the incumbents can come in to help the regulators, and various other mechanisms, whether we're looking at sandboxes and the like. But I wondered from the regional dimension of things. So when we look at sort of regional organizations such as ECOWAS in the African, in West Africa, or look at the East African community, EAC or COMESA, I just wondered if if there are any, if there's any framework in place to kind of, regulatory framework in place to facilitate the functioning or the support, if you like, of fintech startups. And if not, what can be done in your own, as somebody that works in the space, how would you be advising governments or regional organizations to be moving in this direction?
So there are a number of factors that are affecting financial inclusion, both regionally and even locally within the different countries in continents like Africa. And I think regulation is one of them. But even outside regulation, legislation from governments to actually support and reduce barriers to tech companies who are trying to solve financial inclusion problems is critical. So first of all, the regulators have to have a very deliberate strategy of, ensuring that they have policies that support the growth and make it easier for tech companies who are building solutions to solve financial inclusion problems. That's from a regulatory perspective. From a legislation perspective, however, there are things around tax breaks, there are things around access to Forex, because some of the solutions that you build are based on technology where the original equipment manufacturer needs to be paid in FX. And so the foreign exchange challenge is making it very, very difficult for companies who have very limited resources to scale and build solutions that can help solve financial inclusion problems. So perhaps anything from a legislation perspective and from a policy perspective from the government that reduces the cost of building such a technology would be very useful. So tax breaks would be very helpful. And ensuring that import havens are created for such companies, and accessing FX at very good rates would really help them to become more efficient in building those kind of solutions. And from a regional perspective, you do have conversations that are going on between African countries to allow the free movement of people. Reducing visa barriers, for example, is very helpful. We spoke about that in the conference I came from in Kigali. But also the cost of facilitating trade between countries, because it's been very difficult to quantify how much trade is happening between the different corridors within Africa. So if you go to the East African corridor, for example, there's a lot of trade going on between Kenya and Uganda, Kenya and Tanzania, and a lot of countries within the East Africa region. If you then come down to Central Africa and if you come down to West Africa, however, you would find that there's a lot of trade going on between Nigeria and Ghana, Nigeria and Cameroon, and a lot of Francophone countries and Nigeria as well. And then, reducing those barriers and allowing those transactions to happen formally by supporting companies who are building technologies to facilitate the exchange of value is also very useful. As you probably are aware, one of the biggest barriers to inter-Africa trade is because right now it's very different. In fact, I don't know of any currency between two African countries that exchanges directly for each other. And that really is one of the things that is forcing people to operate outside the formal financial sector. So people actually carry cash, travel to these countries and trade. And it's very difficult for that trade to happen electronically because the two currencies don't exchange directly for each other. And because of the global financial crisis we have now, and virtually every African currency is suffering a devaluation against the American dollar, it's been extremely difficult. But I think, first of all, for governments to really understand the importance of closing the financial inclusion gap, understanding the importance of having a vibrant and thriving financial technology ecosystem, first is the barrier that most African governments need to get past. Understanding how critical it is to solve those problems before it then gets them to the stage where they're willing to come to the table and sit and have a conversation with each other. I think it's something that needs to happen, and was something that was spoken very passionately about last week when we were having a discourse, where it was essentially people from the private sector that saw this as a big problem, but somehow that message needs to get to people who are responsible for legislation and regulation, and get them to be on the same level with regard to how critical it is for us to solve those problems now, so that it then forces us to have a conversation with each other in terms of governments talking to governments and saying, how do we break the barriers that, create some friction between exchange of value between our countries, so that we can help our economies to grow. I mean, what's happening with the war in Ukraine and contraction happening in several advanced countries is really affecting Africa. And we need to look beyond free aid. We need to look within ourselves and say, what can we do amongst ourselves to ensure that we reduce the effect of the shock we're seeing from the global financial crisis? And I think it's really something that African leaders need to, recognize how critical it is and start having these conversations quickly.
Brilliant. Thank you so much. Thank you so much for that. Very insightful. I mean, you spoke about currency inconvertibility, which, like you say, is one of the fundamental problems affecting intra-regional trade, so intra-African trade, which is amazing. And I just wonder the extent to which things like central bank digital currencies, because there's so much you said in answering that question, where you said there's a lot of informal trade happening between the corridors, whether it's the East African corridor, the West African corridor, across the nations, but that aren't accounted for, and therefore governments, for example, lose tax and lose one, So I just wonder the extent to which things like central bank digital currencies, for example, can help to sort of allay those, and the extent to which we could have sort of regional, an equivalent of a regional central bank digital currency that can maybe potentially deal with that whole problem or inhibition, if you like, of not having currency compatibility. And you rightly said that sometimes you actually find you can't convert. You'd have to convert for example, the naira to the dollar to get the CD, or and in order to be able to pay for a transaction in 2022. It's just it's quite sad to see. So it'll be interesting to watch the space. And really, on behalf of the Centre of FinTech, thank you so much for your time, your preparation for this, for answering the question so very clearly and eloquently. I'm sure our listeners would find this very, very beneficial. Listeners here being our students, external stakeholders, and every other person that would visit our website to actually watch this. This has been amazingly useful. So thank you very much, Ina. And just to say that my name is Dr. Iwa Salami, co-director of the Centre of FinTech, and it's been an absolute pleasure speaking to Ina Alogwu.